Roth conversions can be a game changer, saving you thousands of dollars in your retirement, but only if they're done right, considering the timing and the taxation of those Roth IRA conversions. In today's video, we're going to break down exactly how you can potentially save thousands in your retirement with Roth IRA conversions. Hi, I'm Maximilian of Truly Aligned.
And I'm Erin of Truly Aligned. We help you make financial decisions to preserve your future and maximize your wealth. Today, we're talking about how to keep more of what you've built. So first of all, what is a Roth conversion? When you've saved money towards your retirement accounts, oftentimes it can be in a pre-tax or a traditional account. A Roth conversion means you're going to move that money from a pre-tax account to a Roth account. You're going to pay taxes today. When that money's in your Roth account, you get a couple benefits: tax-free growth, tax-free withdrawals later in life, and a lower tax burden when you're in retirement. Instead of waiting for the IRS to take a big chunk of your income, you can take control today so that you can set yourself up to have tax-free income later in life.
Why does this matter for your retirement? At 73, the IRS forces you to start taking funds out of your traditional or pre-tax account, regardless if you need the money or not, in the form of required minimum distributions, also referred to as RMDs. The advantage of a Roth conversion for your retirement: it can lower your tax burden by reducing your required minimum distributions for your traditional and pre-tax accounts. So when is the best time to do the conversion? The sweet spot is typically early in retirement. For most of our clients, if we're able to, we advise them to build up cash right before they're going to retire. And for the first couple years in retirement, before Medicare kicks in, before Social Security kicks in, before required minimum distributions kick in, we're doing the conversions while living off cash. So we're at a lower tax bracket for those conversions. We work with a lot of business owners, and if you've recently sold a business, you typically have a lot of cash on hand that you can live off, so you can convert your funds over during that time period at a lower tax bracket. The crucial part is to make sure you're converting at a lower tax bracket. We'll talk about why that's important next.
In 2026, the current tax laws have a sunset. They could stay the same, which has been indicated by the current administration, but this goes to show that each administration is different and the tax laws can change. Whether it's 10, 20, 30 years from now, things might be different and we might have different laws in place, which means doing the Roth conversion today provides you with flexibility in the future to dictate and determine which tax bracket you choose to be in.
So the last question is, how do taxes impact my conversion, and when does it make sense based off my top federal tax bracket to do the conversion and not to do the conversion? In general, we typically draw the line in the sand at 24%. If you're at or below 24% for your top federal tax bracket, a lot of times the conversion can typically make sense for your financial plan. When we look for our clients for our detailed tax analysis, you're typically withdrawing those funds at a lower tax rate. For most people, your tax rates are normally lower in retirement than they are in your working career, as you typically need less money to live off in retirement. If you're above that threshold, say at 32%, which is the next tax bracket up, a lot of times the conversion strategy may not make sense. Now, keep in mind, this is general advice. The crucial part is to do the detailed tax analysis, determine what your tax rate would be in retirement based on your financial plan. That's something that we help with at Truly Aligned.
There's a fun bonus when it comes to Roth conversions, is that it's not just for you, but it can also be for your heirs. When you pass away and you leave money to your heirs, if it's in a pre-tax or traditional account, your heirs will have to pay taxes on that money. And they're probably at a pretty high tax bracket when you pass away, which means that they're going to be paying a lot of money in taxes. If you do the Roth conversion, you're able to leave behind money to your heirs that has already paid taxes, and your heirs will have tax-free inheritance.
Pro tip: be aware that Medicare and Social Security may be impacted. If you have a spike in income, your Medicare may become more expensive and you could receive less money in Social Security. It's crucial to be aware of that.
If you made it to the end of this video, be sure to hit the like and subscribe so that you can stay up to date with Truly Aligned insights on what to do with your money. And if you have any questions, drop them in the comment box below or book a call with us. We're happy to help. Until then, stay aligned.